All right, well, thank you very much for joining me in this session. My name is Jesus Rodriguez. I'm the founder and CEO of IntoTheBlock, and we're here to talk about a lot of fascinating metrics about crypto assets. So I'm going to walk you through a lot of different analytics that sort of challenge your common belief about the crypto space, and that sort of make you think about different angles in which you can analyze the behavior of crypto assets. We have a lot of ground to cover and a very ambitious agenda, but hopefully we'll make it really fun. As I said, today we're going to be focusing mostly on describing some common metrics about the behavior of crypto assets. So a little bit about myself, just to set the context. I'm a computer scientist by trade. I have a long career in tech as building quant systems in Microsoft, building cloud systems in Microsoft, quant systems in Wall Street, have a background in machine learning and artificial intelligence. I've had a couple of exits as an entrepreneur, became an active investor on different startups. I'm currently teaching different AI courses at Columbia University, and I do a lot of speaking and writing, but main focus this day is the IntoTheBlock, that we are a data science platform that tries to derive insights from crypto assets just using cutting edge machine learning and data science technique. IntoTheBlock is a relatively new platform, about 16 months old, but with a very big customer base. So we just crossed 50 customers, and you can see some of the big brands and names that everybody recognizes in crypto that are using our platform, but also making it available to their users, from crypto exchanges to data providers to media sites and funds and different projects. The analytics that the IntoTheBlock is providing via data science have become very popular. But we're not here to talk about IntoTheBlock. So as I said, we have a very ambitious agenda. The first part, I want to use a few minutes just to convince you of a very simple thesis that crypto is a new asset class, and that requires has new fundamentals and requires a new type of analysis methodology. Then I want to divide the next section into three main subsections. One, we're going to talk about blockchain indicators, just pure blockchain indicators that can bring very unique insights about the behavior of crypto assets. And then the next two, we're going to talk about how blockchain indicators can complement both order book indicators as well as derivative indicators, and try to provide some very unique perspective about crypto assets. And then to close it out, then we're gonna present a very provocative thesis in which we try to complement technical analysis with blockchain indicators. So it should be very fun. So let's start with a very obvious statement. Crypto is a new asset class with very different fundamentals from any other asset class that we have seen before, and as a result, sort of deserve a new type of analysis that is not based on the same criteria that we use for other asset classes. Now, that's pretty obvious, right? Every single financial asset class in history have brought up different analytical factors. So, for instance, the stocks and equities are mostly based on price and volume. Currency, when Forex markets started, brought the innovation of 24/7 trading. Commodities are mostly based on supply and demand. Fixed income, these vehicles pay a dividend. So crypto is what makes crypto unique. One of the things that is completely unique about crypto is the amount of data that it generates. So from some perspective, even though crypto is a very new asset class, it might be considered the richest asset class in history, and it's the first one that records the behavior of individual investors in public ledgers that are available to everyone for mining purposes. So if you think about having that data set at your disposal that describes the behavior of groups of investors, that's extremely unique. Now, if that's true, right? Why do we keep analyzing crypto, like using the same type of techniques that we use from any other asset classes, like technicals, right? Technicals are great for certain things, but obviously they're far from sufficient to create a thesis about the behavior of any asset. Nonetheless, a new asset class like crypto. So we believe that analyzing crypto assets by just looking at price and volume and ignoring a brand new data set in the form of blockchain records that you have at your disposal is really just being lazy, because you have this data set that is available to everyone, and just ignoring all those factors and thinking that everything is going to be reflected in price and volume is just a difficult thesis to sustain in a complex market like crypto assets. So bottom line, crypto requires, like any other asset class, has very unique factors that would drive a very unique analytical techniques. Now, if you think about analyzing crypto assets today for trading, for investing, trying to develop a unique thesis, what are the avenues? What are sort of the data sources that you can use? Obviously, there are a lot, but fundamentally, there are three main vectors that you should think about. One is derivative, that is becoming a very prominent component of the crypto space. Obviously, we have records from order books that describe the behavior of traders on different exchanges, and we have blockchain indicators, blockchain data sets as well. So if we think about the intersection of those three of those three vectors, right, derivative, order books, and blockchain indicators, the portion of blockchain indicators, as well as the intersection with the other two vectors, is what drive very unique sources of intelligence. Obviously, any blockchain-based analytics is very unique to crypto, and I can offer an edge compared to other asset class. And then the intersection between those blockchain indicators as a complement to derivative and order book indicator is also very unique. So what I want to do for the remainder of the session, I would just want to show you a ton of data about different theses about crypto markets. The first part is going to focus just on pure blockchain signals. The second part is going to focus on blockchain plus order book plus derivative. And then the third part, we're going to look at how blockchain indicators could serve as a complement of technical analysis. So let's start by showing a few examples of how blockchain indicators can provide some very unique edge, some very unique intelligence, some very unique perspective about the behavior of crypto assets. So let's, for each one of the analytics I want to show, I want to sort of pose a question that sort of illustrate what this analytic specifically is trying to address. So a common question when we decide to invest, to make a trade in a specific crypto asset, is we would like to understand how many people are making money or losing money with this type of investment. Who is on the other side of the trade? How does the composition of this asset looks like? Now, that question is effectively impossible to answer in any other asset class, because we don't have access to the behavior of records that describe the behavior of individual investors. But in crypto, we have access via the blockchain records. So this analysis that we do in the IntoTheBlock platform, called the in and out of the money around the current price, it tries to provide a perspective of profitability at a close distance of the current price, like around 15% distance of the current price. So we look at all the addresses that have been recorded on the blockchain that are active, that are non-exchanges, and then try to identify the 10 most significant groups. So when we look at Bitcoin this morning, through this analysis, you can see here that there is about 623,000 addresses that bought BTC between 9,800 to 10,100, and they're out of the money compared to the current price. So that effectively means that if Bitcoin continues to go up, that this is going to add as a level of resistance. So, but in order to get to 10,000, Bitcoin is going to have to clear through a percentage of those 600,000 addresses, which is not that many. So it's very conceivable that Bitcoin will rally up to the 10,000 mark relatively soon. So, and that's an analysis that we can do by just looking at individual addresses at a blockchain level, which we cannot do with any other asset class. Every single analytic that I'm showing you here is available in the IntoTheBlock platform. We're not showing you, well, maybe a couple of things that are coming down the pipe, but you can access to all this as part of our free trial edition. So how about Ethereum? If we look at this same perspective for Ethereum, then it shows that, look, there is a huge level of resistance to get to 220. So 719,000 addresses, which in the case of Ethereum is a lot. So in order to clear from 1214 to 220, Ethereum is going to have to do some work. Similarly, if the price goes down, these levels here that are between 208 and 213 are as a level of support. So this gives you a very pragmatic view of support and resistance level based on what people are buying or selling and their positions historically, not just based on price and volume. I hope that makes sense. That's a very unique type of analysis that you can do that drive value and provides an edge in many trades. So how is this helpful? Well, it provides very unique levels of support and resistance. It gives you an idea of investor sentiment, right? If everybody's losing money, these are people that might not be willing to trade. So you might be dealing with a lot of psychological factors that are outside their position, and it provides a pragmatic view of counterparty, like who is on the other side of the trade. How does that composition looks like? Let's look at a different examples. How about, so what I showed you were investors that were in very close proximity to the current price, but how about historical? Like if I look from the very beginning of a crypto asset, how does that look like? Well, an example that I love to use in this case is Bitcoin Cash, because as you remember, it was a fork of Bitcoin. It was there was Bitcoin Cash were distributed to every Bitcoin holder at the very beginning. So you can see that there is a huge population of investors that receive Bitcoin Cash at $0, and consequently, since the beginning of Bitcoin Cash, 85% of investors have realized gains. Now, if you look at the active trading population of Bitcoin Cash in close proximity to the current price, the analysis that I showed you before, this picture looks different. It looks like a 50-50 type of thing. But if you looked at it historically, only 14% of investors have lost money with Bitcoin Cash, which is a remarkable statistic. So how is this helpful? It shows you clusters of volume. So if the price is in certain vicinity, you can start looking at what are the volume of investors in that proximity. You can look at inactive tokens, so Bitcoin Cash that haven't moved in a year or two, as well as whales, large token holder positions. Again, this is information that you cannot find in any other asset class. So a different type of analysis. So how often does a crypto asset changes hands? So what's the frequency of trading? That's also not dictated by volumes, could be transfers, could be other things. So in the blockchain ecosystem, there are two types of fundamental blockchains. There are more, but there are two architectures that dominate the ecosystem. One is account-based blockchains like Ethereum, Ethereum Classic, and so on. And another one is UTXO, unspent transaction output blockchain like Bitcoin, Dash, Litecoin, Bitcoin Cash. So every time you do a transaction on Bitcoin, the UTXO transactions are recorded that serve many purposes, but one of them is that they record the age of those specific Bitcoin. In some sense, in some level of abstraction, the entire Bitcoin blockchain can be seen as a composition of UTXOs. So using that analysis, those UTXO transactions, we can extrapolate the age of Bitcoins on chain. So we can show you how many Bitcoins are older than 1 year, how many Bitcoins are between 3 to 5 years, how many Bitcoins are younger than 1 day. And you can see where these streams change in volume, how coins that haven't moved in about 3 years, they start moving, and you're going to start identifying those trends that are very important in order to anticipate price fluctuations. I was looking at this chart the other day, and in a year to date, the number of Bitcoins between 2 to 3 years, it has grown by almost 50%. So there is a lot of people that are accumulating Bitcoins on that range of 2 to 3 years, which gives you an idea of long-term holders in the network. So if you think, let's move from Bitcoin and look at the same analysis for something like Litecoin. This somehow, so look at the price curve and look at the stream here of Litecoins that are between 1 week to 1 month. The correlation between those two is remarkable. So there is, for some reason, in the Litecoin blockchain, this type of the stream of ownership between 1 week to 1 month, it has very strong correlation with price. So this is the type of analysis that you can infer by looking at individual positions that is just impossible by just looking at price and volume. So how is this helpful? Again, shows you accumulation trends. It shows you movements of inactive coins that were a year old and are moving, as well as where are those long-term holder positions, where are those accumulating, and offer, again, very pragmatic levels of potential support and resistance. So one dimension that is super important to understand when you're going to invest in a crypto asset is time, right? Are people holding for a long time? Are people trading like crazy? Is it both? So looking, volume does help with that, but you know what is more interesting than volume is looking at individual addresses on the blockchain and see how long they hold their specific positions and try to infer some patterns from that. So this is an analysis that we call ownership by time in the Dash currency. That Dash at the beginning of the year, and Dash is a customer of ours. At the beginning of the year, they experienced a spike in price, and you can see that in this type of analysis, we try to factor in new addresses that are actively trading. We call those traders, medium frequency holders, and long-term holders. And the number of new addresses started growing very fast, because as the price was going up, new people were coming into the network and they were actively trading, and that sort of also fueled the price rally. So that's an important metric that gives you a unique perspective about a potential price rally. Now let's look at that through the lens of a recent event like the Bitcoin halving that it kept everyone on their toes for the last few days. So some of the metrics that we observed related to time in the anticipation of the Bitcoin halving was that large holders were accumulating Bitcoin. So these are the red line here shows number of addresses that hold over 100 BTC that are non-exchanges, of course, and these are number of addresses that hold over 1,000 BTCs, and you can see that those numbers are being increasing in the last few days prior to the Bitcoin halving. But the interesting thing is that it was not only the long-term holders. If we look at addresses that were holding at least 1 BTC or 10 BTCs, you can see those curves also growing. So there was a lot of accumulation going into that event, and that's the type of analysis that you can do by simply looking at time dimensions in the blockchain. So how is this helpful? Well, it shows you things like momentum, right? Like long-term holders accumulating more positions, is money moving from long-term holders into medium frequency traders, and things like that, and give you an idea whether the network itself is long or short about a specific crypto asset. So following that trend of thought of trying to inspect individual addresses, another analysis that is interesting is, you know, how concentrated an asset is. In the crypto space, we have the concept of long-term of big holders or whales. So individual investors that accumulate large positions, and when they do trade, they move the price. This is the equivalent in equities of an activist investor taking a position on a specific equity and sending an article to the New York Times and making a ton of noise and moving the stock in their favor. So in the case of crypto assets, many assets are susceptible to those market manipulations. So this analysis that we try to understand concentration and identify the whales on a specific asset, as well as the retail volume and investor volume. So you can see in the case of Bitcoin Cash, there is a small 5% that is accumulated by whales, but then you look at another asset like Chainlink, and you can see that it's disproportionately owned by whales. So maybe a riskier position. If this volume start dumping, then it's definitely going to move the price, and that's another analysis that is helpful in the sense that it shows you what are large investors doing, as well as that's the risk of a potential market manipulation or massive sellout. So another super cool analysis that you can do by just looking at blockchain indicators is trying to trace the money that flows in and out of exchanges. I mean, if you're an equity investor, how much money would you pay for knowing what's flowing into the New York Stock Exchange or the NASDAQ? And that's obviously impossible. At the blockchain level is very hard, but not impossible. So you can, it's definitely a machine learning problem. There is no discrete solution for this type of problem, but you can train a series of machine learning models that help you identify changes at the blockchain level. That's what we did, and this is what these visualizations that you cannot make any sense of them, but that's what they try to show. So it tried to identify the architecture of individual exchanges. To your left, you have Binance. To your right, you have Poloniex, and it identifies whole wallets, cold wallets, deposit addresses that are the address that investors deposit the funds prior to going to the exchange, withdrawal addresses that are the addresses that the funds go when you do a withdrawal from the exchange. And in the case of Poloniex, you see multiple hot wallets and the same sort of taxonomy. So having those metrics, we can do many cool analysis, like trying to figure out how much money is flowing in and out of the exchanges, how much money is being accumulated in all the deposit addresses. How does that correlate with order books? Like you start thinking about a lot of very, very unique type of analysis. So for instance, this metrics here shows for all exchanges in Bitcoin, how those inflows, right? The green lights are money going into exchanges, the red lines are money going out of exchanges, and you can see the correlation with price and how that trends over time. So you can start monitoring things like a big transfer going into an exchange, and what that could signify. Let me illustrate that for you. March 11, there was a massive crash in the Bitcoin price that almost crashed the entire network, literally. And looking at this analysis, you can see that there were massive levels of inflows going into Binance, right? That precipitated the price drop. And obviously, people were moving money to Binance to liquidate their positions. So looking at this trend could have, help you better trade on the way down on the massive crash of March 11. So that's a unique analysis that you can do by looking at blockchain flows at the for exchanges. So that allows you to monitor money moving in and out of exchanges, anticipate large fluctuations in price. If you see a massive amount of funds going in or out, you can extrapolate what that could mean for the price, as well as quantify risk levels. So another analysis, I think this is the last one I'm going to show you at the blockchain level, is about geographical distribution. Bitcoin, crypto is a 24/7 market. Sometimes you go to sleep, you wake up, and the market has completely shifted. So trying to understand that is super important. But also, when you think about the geography of crypto, Asia has a disproportional influence compared to the rest of the world. So an analysis that we like to do is to try to extrapolate intelligence and tell us whether trades happen in Asia or versus the rest of the world based on the exchange you're coming from, based on the time, based on different factors. So this analysis called the East versus West will show you the trades that happen in Asia or in the Western world and in the Western Hemisphere. And you can see Ethereum is incredibly evenly distributed, but then you see other tokens like Litecoin that definitely has a predominance in the West compared to Asia. So if you're a trader in Shanghai and you go to sleep, this is the difference of volume that is being traded when you're sleeping, and consequently is a level of risk that you should assess. So that shows you the geographical influence for a specific crypto asset, as well as level of risk that you can use for a specific trade. So those are analyses that you can do by just looking at the blockchain level. Now, how about by combining the blockchain indicators and order books indicators? So obviously, order book is the fundamental artifact that traders use to determine positions, and there is a ton of research and metrics and indicators that you can use there. But what if you could complement it with what happens at the blockchain level and make it even richer? Let me give you just a couple of examples of that. So when you look, obviously there is a lot of questioning in the crypto ecosystem about the veracity of order books, given that there is massive spreads and things like that. So can looking at the blockchain give us an idea of things like fake volume, market manipulations, and things like that? And the answer is we don't know, but we find some interesting things. So there is an analysis that we like to do is looking at order book spreads for a specific exchange, and also looking at the inflows and outflows going into the exchange, as well as the inventory. And all this is an analysis for Bitcoin. All the Bitcoins that are being held between the deposit addresses, the whole wallet's what is being kept on inventory. And you can see that when during the days of the March 11 crash, there was massive levels of inflows and outflows, particular outflows into this particular exchange that I'm saving the name for reputational purposes. And then you can see the spikes on the spreads going higher as people were taking money out, and you can see that the inventories were decreasing. So typically there should be a ratio between the spread and the inventory being kept on chain and the level of inflows and outflows. And when that ratio varies from certain threshold, then there is probably a sign of risk. And this is a type of analysis that could help you sort of predict variations on the spread and arbitrage opportunities by looking at exchange inflows and outflows correlated with the order books. Then a different perspective of this. You're looking at an order book in order to make a trade. You're seeing the positions on the bid or the ask. And how do you know, is it realistic? Obviously, there is a level of trust in the exchange, but obviously we know that many crypto exchanges are vulnerable to market manipulations or attacks or things like that. So something that we found helpful is this analysis that we call exchange on chain analysis, market depth, that essentially shows you a typical market depth analysis in which you have the bid and the ask, but on top you have the number of Bitcoins that have been recorded on chain at that level. So you can see if these variations go out of crazy, then there's probably something that is not real, right? You should be seeing a decent level of correlation between what's being kept on chain and what the order book is telling you at the market depth level. So again, that helps you to quantify sort of the risk with the order book, and as well as identify potential fake volume scenarios that you might not want to get into. Similar type of analysis could be done for crypto derivatives. So I shows you how blockchain could be used, blockchain indicators could be used as a standalone analytical tool, how blockchain indicators can complement order book indicators, but how about futures, which and perpetual swaps and options that are becoming very important in the crypto ecosystem. So obviously futures play a role in hedging and speculation. So miners, that's a fundamental hedging vehicle for prices, and trying to estimate some of those behaviors has proven fundamentally important in some trades. Into the block, an analysis that we like to do a lot is this one that we call the turnover ratio versus exchange flows. So I'm gonna take a second to explain this. So exchange flows, you already know what it is, right? Money moving in and out of exchanges. Turnover ratio is a measure on futures market that measures the volume versus the open interest, that is the amount of open contracts that you have at any given time. So when those ratios go disproportionately higher, it's a sign of a speculation. Contracts are changing hands all the time, but they're not being traded. So in the days of March 11, the days here are not proportional because the analysis was done in two different timelines. But in the days going to March 11, as we already know, there were massive inflows into different derivative exchanges, and then you could see how the turnover ratio went very high in very good exchanges like OKEX or FTX and all that, which signal a lot of speculation as well as hedging positions being taken. So by just looking at this, you can certainly develop a thesis that there is a speculation going on in the market, but you don't know if it's maybe a market manipulation or something else, but you can then correlate it with real flows going into the exchange and try to develop to sort of solidify that thesis with factual records of what's happening on chain. So how is this helpful? Well, I mean, it could offer the opportunity to identify arbitrage opportunities in derivatives based on blockchain flow movements. So until now, what have we done? We have shown you how blockchain is an ideal complement of different analysis techniques for order books, for futures, as well as a standalone analytical mechanism. Now, I want to take that thesis to another level, bring it all together, and then show you how blockchain indicators could be an interesting complement to technical analysis, which is still the fundamental mechanism that traders use, particularly for judging entry exit points and things like that on a specific trade. When you think about technical analysis today, I mean, there is a zillion of indicators, but for the most part, they could be grouped in 5 fundamental categories. So trend indicators that just follow a particular progression on price and volume and identify those patterns, mean reversions that bank on the fact that when you deviate from certain trend, you're going to revert to the mean. Relative strength indicators that try to measure the strength of price movement. Momentum that tries to predict the intensity of a specific trends, whether they should continue or not, and just indicators based on volume. So I'm going to take 3 examples of those and show how they can be complemented by blockchain indicators. So the fundamental thing that any chartist, any technical trader does in any specific trade is looking at support and resistance levels. So there are many ways to do this, but one of the most popular techniques is what we call Fibonacci retracement levels, in which we essentially establish different lines based on the Fibonacci sequence, and And then those levels will identify a specific points of retracement of a given security. So this is based on price and volume and doing this candle analysis. Now imagine if we could complement the support and resistance level with this in and out of the money around the current price analysis that I showed you at the very beginning. So you have the Fibonacci retracement levels showing you something, but then you can look at the blockchain here in this case of Bitcoin that there is 745,000 addresses above between here and here, and if it clears this level, then it's going to face another 1 million addresses that is here and here, and if the price goes down, there is 137,000 addresses that could add as a potential level of support. Why wouldn't you use this? I mean, it's like a gold mine, right? So it's a natural complement. And we even play with the idea of just creating a different Fibonacci retracement model, just using this stuff as a complement, and it sort of worked. So even if you're not a firm believer on the power of blockchain data sets for this type of thing, you should use it as a complement of your technical trade. I mean, ignoring it just doesn't make a whole lot of sense. Then let's look at a similar analysis for trends. So the traditional type of trend analysis is based on moving average, right? So there is X number of days, 200 days, 20 days, whatever, or exponential moving average that tries to weight the movements of short-term movement as with a higher weight that older movements. So, and the idea here is that you try to identify potential divergence between current price trends and historical price trends, and try to identify levels of mean reversion or potential levels of entry point and exit points and things like that. So a complement that to the moving average is this analysis that we have been showing you of the blockchain inflows and outflows, in which you can be looking at a technical moving average and identify that it is really the current price trend is really diverging from the historical price trend, but then you look at the exchange inflows and outflows and try to solidify that, complement that thesis, and saying, well, of course it's happening because now there is a massive levels of inflow into a specific exchange, so it helps to justify whether your technical thesis is correct. The opposite is also true. You can be looking at the inflows and outflows and develop a trading thesis with this, and then use technicals to try to use moving average to try to identify the correct entry point and exit points and things like that. And then the last example I want to show you is mean reversion analysis, which is incredibly common and in technical analysis, and one of the most used techniques here is called Bollinger Band that was created by John Bollinger in the 80s and has become one of the standard ways to identify mean reversion patterns. So essentially, the Bollinger Bands look at different trend lines based on standard deviations from the price moving average, and with those trend lines, there is one at the bottom, one at the top. They typically identify overbought or oversold patterns, which is the same thing of saying, potential levels of reverting to the mean. So looking at that, another analysis that I showed you before that is a natural complement to this is the UTXO analysis. So if you're telling me that at this level of Bitcoin could experience reversion to this other level, why not to look at the UTXO positions and see whether specific coins that were bought at that are from certain age, that trend is changing, and it tries to complement your technical thesis. And like those, we have a million examples, right? Like we think that technical analysis is more effective when you factor in the positions of groups of investors. It is definitely a more it solidifies your technical thesis. So we think that looking at blockchain indicators, it could really help to sort of develop more sophisticated technical analysis thesis. So Again, there are a million challenges in this space. I mean, some of the analytics that I show you took months and months to put together. Today, our portfolio has over 60 something analytics, but some of them are used very complex machine learning. So some of the challenges that we have experienced that we think are worth exploring. We think the anonymization is sort of the biggest challenge for providing meaningful intelligence in this space. If everything is anonymous, if every address is the same, how can I possibly extrapolate intelligence for miners, exchanges, OTC desks, and other actors? So creating a level of the anonymization, we do it with machine learning, or people do it with other things, is super important. Identifying, patterns by just looking at blockchain data is incredibly challenging. Obviously, the entire space is susceptible to price manipulation, fake trades, and all sorts of bad behaviors that tricks a lot of machine learning models, and it's difficult to deal with. But we're certainly putting a lot of effort to solve those challenges. So, what did we learn today? So crypto assets are a new asset class that requires a new form of financial analysis. Blockchain data sets are a gold mine, and you can use it just as a standalone type of indicators, not recommended, but also a better idea is to use it as a complement to your order book and derivative sort of analysis. And this is definitely a data science play. It's hard to solve these problems by just looking at linear analysis in an Excel spreadsheet. I would like to take a few minutes for questions that I'm seeing on the chat. John is asking, where do I see Bitcoin price next? We don't comment on that. I gave you a thesis that I don't see a lot of problem getting to 10,000. QU is asking, when you use artificial intelligence for analysis, how do you ensure that the correct data is available? Is very complex. So we put a ton of effort. Like, for instance, we're today around a little bit short of 10 terabytes of data, and we put a lot of effort in making sure that we're not missing any blocks on the blockchain. The order books records always has gaps in it, so we need to go back and record trades that we missed, so some of our models don't get confused, and there is a lot of data cleaning that goes behind it, and it's difficult to do, but it's what you need to do if you want accuracy on the models. Another challenge that you have when using machine learning for this space is that there is not a whole lot of label data. And most of the machine learning techniques that people use are supervised learning that need to be trained, but they're not data sets to train it with. So you need to get really, really creative in terms of how to address those challenges. And then Joshua is asking, can I conduct several similar analysis on the Unihash blockchain? Yeah, absolutely. I mean, if we have a copy, right? If what we do is we host nodes for a lot of those blockchains and collect the blocks and the transactions, and that's what we will have to do for any other blockchain. It's a very intensive process. So we have I think over 13 blockchains today, and we're trying to add some. Oh my God, this is gonna get interesting. Yanjin is asking, what's the biggest data manipulation you have seen? So I'm not going to comment on that, but I'll give you one anecdote. We are working on price prediction models using deep learning. Actually, we're going to be launching a version very soon. And we train the same type of models with different data from different exchanges. And when you use good exchanges or bad exchanges, or let's say exchanges that were more susceptible to market manipulation, even the ones that we all know, we saw variations in performance of about 30%. So a predictor that was doing predictive models that were doing 68, 69% would drop to 32. Right? Just that's a level of market manipulation that you see in some of these exchanges, which is incredibly hard to figure out from for a model that is trying to do predictions. What data triggers are you watching for short-term trading? That's also Yang Yin. Many. So we in the spot market, there is a lot of alpha signals just by looking at order books and trade complemented by blockchains. Derivative is huge, right? We think derivative is still very inefficient in this market and therefore offers a lot of alpha opportunities. And as I said, blockchain could complement a lot of that. Now, we don't look at we don't have thesis on single data triggers. We don't believe on a single factor can predict the price. Some of the predictive models that we use use around 78, 80 factors to try to predict a price movement. So Inaki is asking for someone who is young and is trying to start analyzing blockchain data. Where should I start? Well, I'm biased, right? Sign up for IntoTheBlock, app.intotheblog.com. You have a trial and you have over 60 something signals that you can play with. And if you have a specific analysis that you would like to do, just get in touch with our team. IO is asking, many people are calling for big move in Ethereum soon. Are you seeing that as well? Data, I cannot answer that at the moment. We're seeing a lot of, with some of the new tokens that have come to market and some of the movement in DeFi lately, we're seeing a lot of interest in movement in Ethereum. I haven't looked at this in the last week or so to have an intelligent opinion about that. Miles Cruz, so it's suitable to buy Bitcoin now. I don't comment. I don't give investment advice. I'm super bullish on Bitcoin. What are the interesting metrics that you have, Yang Jin, again, prior to having? I have an entire presentation about this. If you go to our blog, you probably can find some of this analysis. I'm not sure if it's the entire thing, but I did it. My session at Consensus was last week was based on this. A lot, like large accumulations, flows going into exchanges, some trends going at historical levels, the 2 to 3 year Bitcoin holders increasing by 50%. A lot of interesting patterns. We don't know if they were predictive of anything, but time will tell. But a lot of interesting movements. Since you see so much data, when is the next coin to buy? I don't comment on investment advice. How do you work with exchanges? Many ways. So we have many exchanges as customers that are offering our analytics to customers. Obviously, we're connected to a bunch, either indirectly or through partners like CryptoCompare and Amber Data that we use their order books. And many exchanges also integrate via our API. Hannah, when analyzing data, how do you choose which metrics are important with so many options? Great questions. Even today, I published a blog post about why rapid experimentations is so important to build this. So we receive a lot of ideas from our customers and community. We have a lot of internal thesis, and then we test a lot. So every single metric, we built an entire platform for deploying different machine learning theses, seeing where it has any value, any correlation, whether it's interesting from the informational standpoint, from the behavioral standpoint, from the alpha generating standpoint. And once we're convinced of something, then we publish it. We have about 3 rules that we try to follow as much as we can. For any signal that we put in the platform, one, it has to have data science rigor. That's what we started into the blog. We're not trying to create simple ratios here. 2, it has to be crypto specific. And 3, we try very hard to develop it in a way we can explain it to a normal person. Like, we don't want analysis in crypto to be a privilege of quant funds and all that. We want anybody to have access. The data is there, so anybody should have access to this. What data, Haran, what data visualization tools are we using? Many. We use D3, we use HighChart, and we use many internally for our own experimentation. Can you share some of the data analysis resources? Absolutely. So drop me an email, jr@intotheblog.io. But if you go to our blog, you're going to find a bunch. But if you drop me an email, I'll answer with a more detailed answer. Joshua, is user-based, number of transactions, utility of the token, number of platforms, important factors to decide the value of crypto? Well, depends of the asset, right? If it's a utility token, obviously the utility is incredibly important. Number of transactions is a universal metric, but you have to know what transactions, right? Whether it's a mining transaction, whether it's a transfer, so it's not that simple to just put a transaction chart. We measure size, for instance, large transactions that could be transferred between exchanges and things like that. Yanjin, what metrics do you find more interesting right now? Many. We're fascinated by metrics that look at financial positions, right? Try to identify financial positions within the ecosystem, and then metrics that are uncover behavior between investors. We think those are awesome. William and Yanjin say hello, so hi back. Well, that's it for me. I have my here's my contact info. You can hit me up at jr.intotheblock.com, through my Medium blog, through IntoTheBlock's Medium. We publish almost 3-4 times every week, and just register for app.intotheblock.com and give us a ton of feedback. We just push a new release today, and there is a ton of information there. So I'd like to thank you very much for joining and all the interesting questions. I know it's super late for many of you. It's been a privilege to be here with you, and I hope you enjoy the show.